Good afternoon, everyone. Welcome to the session today, which will represent the second section or the part 2 of our discussion with respect to revenue from contracts with customers. Yesterday, in part 1, we introduced ourselves to the standards. Also, we tried to align where we're coming from on the perspective of IAS 18, IAS 11, and other interpretations to what we currently have under IFRS 15. And in that light, we went further to define the objective of the standard, and we also look at ways of meeting those objectives, and we'll further define the scope of the standards, as the standard does not necessarily address all form of revenue, but rather it only addresses revenue arising from contract with customer other than those that may have been specifically treated under separate standards, such as that of leases from the perspective of the lessor, that regarding financial instruments, and the likes. We went further to unveil the 5-step model to recognizing revenue. The steps, namely, as follows. Step 1 borders on identifying the contract. Step 2 deals extensively with identifying the performance obligations. Step 3 talks about how to determine the transaction price. Step 4 gives us guidance on allocation of the transaction price to the performance obligations as so identified in step 2. And step 5 extensively provided guidance to how we recognize revenue when performance obligations are met. Okay. And in part 1, we are able to extensively deal with issues that borders on step 1, step 2, and step 3. And part 2, we focus more on step 4 and step 5 as a means of wrapping up our understanding about revenue recognition. Furthermore, this part or session will also go into unique areas of revenue recognition based on certain transaction or transaction types, and probably those types are industry-based. We'll look at all of those other ones, and at the end of the day, we must be able to make justice to it. And before we proceed today, I want to hear 1 or 2 commentaries about how far we've gone in part 1 and what further expectations we may have for part 2. If you are willing to more or less make that narrative, you could unmute and make 1 or 2 commentaries as we proceed in the discussion. Over to you guys.
Yeah, good afternoon, everybody.
Afternoon.
Okay, thank you very much, Mr. Muiwa. With respect to IFRS 15, honestly speaking, the way the lecture is being structured, I think you are going by this explanation step by steps, and it is well understood. Actually, my expectation in respect of IFRS 15 is just to know the basic requirements of IFRS standard and the expectation that we are expected to to adopt, especially people in practice. As a matter of fact, with the way you handle this topic, I have the understanding of the topic, and my expectation is not so high because I understand that you are taking it step by step. Thank you.
Okay. Any other person?
Yeah, okay, thank you very much, sir. Like yesterday was very, very interesting and interactive. And the fact that we could see it not only from the theoretical point of view, but from the practical point of view, and how it is actually been done in the industry. It makes it very, very interesting. So today, I'm still looking forward to the remaining aspects of the program. I mean, of the model. You know, we've done 3 now. We are waiting to finish up with the other 2. So I'm curious to know what's left. What next we're going to do. And also, based on my question yesterday, which is about uh, uh, recognition of revenue in a situation where, you know, series of customers how to use the same products over the product's useful life. I'm very, very curious to know this. And there's also a personal aspect to it, because, you know, I'm writing an article on revenue recognition for various secular economy model. And I want to be sure that what I'm putting out is actually the right thing, so that I don't confuse my audience. So that is why I really want us to discuss on that. Thank you.
Okay, thank you. Any other person before we proceed? Any other person before we proceed? Okay, we will look at, we'll introduce ourselves to step 4. And step 4 deals with the allocation of the transaction price to the performance obligations. Now, how do you go about this? Okay. Now, you all know what transaction price is coming up from step 3. And allocation is only required when you have at least 2 or more performance obligations attached to delivering on a contract as an entity. And what that signifies is that when you have at least 2 performance obligations attached to a contract, you need to then allocate such such transaction price to the 2 performance obligations. If the performance obligations are 3 or more, you do the same thing. Okay, the standard gave us a guidance on how this is being done. First, when you price a contract as an entity who is to deliver such goods or services to a customer, you more or less price based on what you tend to offer in that contract, which means that in most cases, it is expected, and it's what is done in practice, that you will have costed and you will have put up your necessary margin on those individual performance obligations before you agree such together inside a single contract. And what that presupposes is that most times you have the knowledge of the standalone prices of those performance obligations. And what it then means is that if you have such, then you can easily split the transaction price into those performance obligations. For example, if you're a telecommunication company and you run a contract line, it's not common in Nigeria, but it's common in the Western world. You run a contract line. A contract line is a line where you pay a particular fee and in which you have access to call within the local network on limited time.
Yes.
Okay, which means what they've done is like an insurance policy where they've collected all risk. You might be 24 hours on phone. Somebody else is just 5 minutes on phone in a day. And by the time they sum up all of the population, you find out that everybody has more or less paid for everybody. And that's how it operates. And in most contracts, mobile service, it comes also with some phones in order to more or less encourage or lure customers to themselves. And they will tell you that they are giving you phone for free, but your contract attracts a premium or a rate of, let's say, $50 a month for unlimited local call hours. Now, the question is this. The $50 you are paying every month for the airtime, which is going to allow you to call unlimited number of minutes, once is a local call in a month. Is it actually the $50 for that service? Are we also going to say the phone given to you is given to you for free? The answer to that is that no. The phone given to you is not for free, even though it is projected as if it's free. Or rather, there's a price directly or indirectly attached to the phone. Now, prior to this standard, there was no clear guidance. And what happened is that such phone, once it's given, it's not recognized. Revenue is not recognized on the phone. Rather, revenue is recognized by way of that $50 every month, provided your contract of having access to the telephone service is still existing or is still valid. But under IFRS 15, such is not applicable. Rather, it is implied, even if it's not expressly stated, that there are two performance obligations that the telephone company has more or less entered with you as a customer. And what are the two performance obligations? The first one is to provide you a phone. The second one is to provide you service, unlimited call hours, local call hours. The question then is, you need to identify what price is the phone being made available to the customer, and what price is actually the call hours. Now, usually such contract goes for a minimum defined period. Some contract might be for 1 year, some might be for 2 years minimum. What that presupposes is that if it's 1 year contract, it means you have to pay $50 each month for the next 12 months. And that is $600. Now, what step 4 requires from us is that since we have identified in step 2 the performance obligations, and since we have identified in step 3 the transaction price, therefore step 4 says, how do we allocate the transaction price in step 3 to the performance obligations so identified in step 2. Doing so, what do we do? We'll more or less look at the standalone prices to say the phone, normally, if you are to sell such phone, how much will you have sold that phone? Probably you have been selling the phone before now, before you change to contract hours. Therefore, what will happen in that light is that at the end of the day, you are going to sell the phone probably for, let me say the phone will have gone for $100. Now, the phone is $100, okay? Now, but the total contract is $600. It then means that invariably, if the standalone price of the phone is $100 and you take that out, what is left is $500. Impliedly, $500 is deemed to be the transaction price attributable to having access to call lines, unlimited call lines for 12 months, which impliedly, on an average basis, if you divide $500 by 12 months, on average, what it means is that the price will be 500 divided by 12 would be $41.67. And what that means that if you have to recognize revenue each month from the perspective of the core service, you will be recognized average of $41.67. Whereas with respect to the phone, you will recognize revenue once the phone is delivered at the price of $100. That is what it is. But it's not as easy as I said it. Why? It's because we might not have a standalone price that will have been appropriate for us to allocate transaction price to performance obligations. And this might be as a result of different things, which we are going to come across. And majorly, some are attributed to the fact that if you have looked at the standalone prices, discount may not have applied. But because you are performing 2 or more performance obligations at the same time, discount might have been involved, incentive might have been involved, and etc. Sometimes you might not be able to obtain standalone prices because the nature of the goods and services that you are providing is such that it might not be easy to identify them on a standalone basis. Okay, and in that way, what the standard provides as guidance is for us to make use of any of these 3 methodology or approach. The first one is to use the adjusted market assessment approach. What that simply says is that look at relatively what will have been the price of phone, subject to adjustment, especially if it's a customized phone, which you cannot easily get outside. You look at what is the price of similar phone, subject to difference in the customization, if any. And likewise, what is the average price that will have been paid for such access to call line, even by competitors, if there is no issue of phone attached to it. Okay, we'll use that as a basis to, or as a ratio to allocating the transaction price to the performance obligations. Second option that can be used where the first option might not be available or not appropriate is to use the expected cost plus a margin approach. What does that mean? The company or the entity will look inward to say, these 2 performance obligations, what will it cost me to deliver them? And what is the average margin I expect to earn on each of them. Phone, probably if I buy phone, I bought it for $80, but I want to earn 25% margin on it. Probably that's will make it 100. Two, the service. What does it cost me for network connectivity, depreciation of infrastructure, operating costs, and some other things, regulatory levies? When you put all of them together, what does it cost me? It cost me $30. Okay, what margin do I want to have on it? Probably I want to have 30%. Now, on that basis, you use it to determine what is like a target price, which you now use as a proportion to allocate your transaction price. The other one, which is the last one, where the first two may not be appropriate, is to use the residual approach. That is, what you do in that regard is to say, out of the two performance obligations, there's a particular one I can easily assess independently what is the observable standalone price is. And let me say for the phone, if that is the case, I can either say, okay, if the actual price of the phone in the market probably is $80, and is a phone that anybody can have access to in the market, and the entire contract is $50 for 12 months, which is $600. It then means that I can take back out the $80 and the residual, which is $520, will be taken as the allocated price for the second performance obligation. And we're going to see all of this as we move on. Okay, and one thing we need to note is that certain criteria which are restrictive in nature must have been met for us to be able to use the residual approach. Okay, which means residual approach is like the last resort to allocating transaction price. Now, before we go further with practical demonstration, I'll be willing to entertain any question at this level. Any question? Any question? The floor is open.
Okay, I just have a comment. You know, especially when you were talking about standalone selling price, like if there's no standalone selling price, we should subject it to any of these three approaches. So my example would be from the same telecommunication services that you've been talking about. For instance, when you sometimes when you buy a package that consists of SMS, mobile data, and also ability to make unlimited calls, and you will realize that all these three still have their own standalone prices. For instance, if you want to buy, regardless in megabytes you want to buy, there's a price for it, there's a price for the calls, and there's also price for SMS. And at the same time, you can still buy them as a single unit, but with a much more discounted price. To the extent that the standalone price of mobile data cannot be used to separate the three when you want to account for them. So is it in such scenario that you now have to look at any of the three approaches in order to allocate transaction price?
Okay, you know, again, most part of the IFRS is principle-based, which means substance of the transactions, the nature and the circumstances dictate more often how transactions are treated for accounting purposes, which means it's less of rule-based. Okay, because things might look similar, and they might be accorded different treatments in order to reflect the commercial substance of those transactions. Now we are going to see some more deeper practical illustration that will address some of your concerns.
Okay, sir.
Okay, and we are going to break it down from more simpler day-to-day things we are exposed to more critical ones, where certain pricing mechanism, strategy, and techniques are being adopted by companies. I'll give you an example. A company might have 3 types of products: A, B, C. Product A is $10. I think let me use Excel so that I can see it clearly. Standalone prices. Products A, B, and C. Your standalone price is 100, 120, 80. Okay, and they tell you that the product can be sold in bundles, bundle pricing. If you are buying product A, B, C, instead of you to have paid 300, they tell you is 280. When you buy product A, B, instead of you to pay 220, they will say you paid 200. When you buy products B, C, instead of you to pay 200, that is 120 and 80, you still pay 200. If you buy 8C, instead of you to pay 180, you still pay, you pay 160. Now, conventionally, let us assume this does not exist for once. If this does not exist as I've taken it out, and you see product A, B, C, that is, the only time you can do it is that when you buy ABC. That's only where you can get discounts. In that case, if they tell you ABC, naturally, you can get it for 280. What you will have done using standalone price without any constraint is to say allocated price. Allocated price will now be the fraction. Remember, if you have bought them one by one, the total will have been 300. But if you buy them together, they said you paid 280. Now, when you pay 280, what it simply means to the entity is that the entity has priced it on the basis of standalone price, which is ratio A standalone to the total. I will lock it, multiply by this price. On that basis, I'll do this. And on that basis, this is what standalone price basis of apportionment or allocation is. But this will not be the case if you are aware of this information, that there are different bundles. Bundle price. The bundle pricing is this. Now, can you observe a pattern in what I've shown here? Who can tell me? I'm still very observant in this pattern. If you have this information now, it nullifies this. Let me come with my share. Now it nullified this. Okay, how will I split this now? Who can tell me how will I split it? Look at a pattern here. When you buy ABC, it's 280, which means there's a discount. Let me just say discounts or incentive or rebate, any language you use. Is a difference between this, Abby? And this. Which means when you drag it on, what is the discount? The discount here is the sum of AB minus this, Abby. The discount here is the sum of BC minus 200. No discount there. The discount here is the sum of A and C minus 160. Therefore, can you see a pattern? What is the pattern you are seeing?
The pattern is only observable for the first, second, and the fourth. And
what can you deduce from it?
Like there's a 20 Naira discount on each of the packages, each of the bundle.
Okay, it might not be exactly 20 Naira all, but okay, in this case, but there's something unique. Who can tell me what is unique? What is the common factor wherever you see discount apply?
It's because they all have product A.
God bless you. They all have product A. Why is it that product B and C, when they are together alone, there was no discount? It then means that in this case, if you are to allocate, you simply say 20% discount is only to incentivize purchase of product A, along with any other product. Which then means that if I'm to allocate this 280, 20 will be taken out of A, which means my allocation will now be what? My allocation will now be, sorry, okay, let me take it up. My allocation will now be what? Look at it. It will be 100 minus 20, which is a common factor. Others price remain what? The same. which means even when I use standalone price, there's evidence that has shown that that 20 discounts, where if you sum up all of them, it will not sum up to 300. Rather, it sum up to 280. That 20 is only a discount applicable whenever you purchase product A in combination with any other products. Does that make sense?
Yes.
Now, that's why I'm trying to answer your question. That it's not something that is rule-based, where you just say, okay, when you get this, do it like that. No. You look at the nature, you look at the circumstances, you look at the whole substance. And remember, you are the entity that is determining your price. And you don't just determine your price anyhow. We have over 6 to 7 to 8 pricing strategies, from marketing strategy to organizations. Therefore, there is a basis in you that has formed the decision towards determining your price in this manner. You must also take that into consideration, which means finance function. We also speak to the product development and marketing function to say, what is the rationale behind this pricing, so that we can be able to allocate appropriately. Are you getting it?
Yes, sir.
Companies don't just determine price anyhow or anything. There's something behind it. If you understand and appreciate what is behind that, you automatically always get it right. Does that make sense, sir?
Yes, sir. It does.
Okay. I'll just label it scenario 3 or accidental scenario. Let me put it as accidental scenario. Is that not? Okay, we'll come back to other scenarios later. Now, let me go back. Now, all we have discussed so far, I want somebody to summarize it in a manner that I believe we should understand. Over to you guys.
Okay, step 4, allocation of transaction price to the performance obligations. Where a contract contains more than one distinct performance obligation, a company allocates the transaction price to all separate performance obligations in proportion to the stand-alone selling price of the good or service underlying each performance obligation. If the good or service is not sold separately, the company would have to estimate its stand-alone selling price. So if any entity sells a bundle of goods or services, which it also supplies unbundled, the separate performance obligations in the contract should be priced in the same proportion as the unbundled prices. This would apply to mobile phone contracts where the handset is supplied free. The entity must look at the stand-alone price of such a handset, and some of the consideration for the contract should be allocated to the handset.
Okay, thank you. Now let's look at this illustration. Anne, can you read the illustration? And let us attempt solving it.
Illustration. A mobile phone company gives customers a free handset when they sign a 2-year contract for provision of network services. The handset has a standalone price of $100 and the contract is for $20 per month. Prior to IFRS 15, the company would recognize the revenue in relation to the handset and a total of $240 per annum in relation to the contract.
Okay, thank you very much. Now let's switch to our model. how are we going to attempt solving this? Which means under IAS 18, this accounting will have sufficed under IAS what? 18. But now, how do we do that? First is that there is a contract for call time. Have we? How many years? It's a 2-year contract. 2-year contract is equivalent of 24 months. Is that not? 24 months. Okay. What other information do we have? We have the transaction price. Being the transaction price per month. Is how much? $20. Okay, which means transaction price over 2 years is 24 months multiplied by 20. That's 480. Now, we have performance obligations. Who can name them? One, supply of mobile handsets. Second one, unlimited call time for what? 2 years. Therefore, our concern is how do we allocate the transaction price of 2 years contract to performance obligations? Allocated price. Now, this question is so easy where we are given standalone prices, or at least we're given standalone price of assets. And since we are given standalone price of assets, which is how much? 100. We don't have standalone price of the call time. Which methodology out of the 4 methodologies, standalone price methodology, since it's not observable for the 2 performance obligation, it's only observable for 1. Which one can we use based on available information here? Which one are we going to use? Which one are we going to use?
I think is receipt after revenues and price of the performance deducted expected cost plus adjusted market assessment.
Which one are we going to use? Who will answer? Who will answer? Now, we are going to make use of the residual approach. Why? We have facts about standalone price of the assets. Therefore, I'll come here, I'll say, okay, the asset is this. Are you getting it? And I'll say the other one will be the difference between 480 and 100.
You're not sharing your screen yet.
Okay, sorry. This is a residual approach. This is a residual approach. Now I can use the other approach. Which other approach can I use? And later on, you tell me which one is much more favorable to be used under IFRS 15. Which other approach out of the remaining 2 can I use? Since the standalone prices are not observable in totality. Which one can I use? Can I use adjusted market assessments or expected cost plus a margin? We don't have information relating to margin or even the cost. Therefore, what is only alternative available is adjusted. Now, let me use the adjusted market approach. What is that approach talking about? The approach is saying that on a normal day, even this $20 is equivalent of what competitors charge without giving free assets, which means that is more or less the market, what the market rate is. Now, if that is the case, it then means that conventionally, what ought to have been charged under this approach? What ought to have been charged based on market assessment is asset, standalone price of assets, and standalone price of unlimited call time. And what is it? This and the 480, which is 20 or 2 years, which means all is 580. Now, since my assumption here, I put it in green as an assumption. Since my assumption here is that the price is charged by competitor, therefore I won't see this as adjusted market price. I might just convert it back to standalone prices. I convert it to stand okay, now what do? I come here to say, okay, if this is it, I can now use it as a proportion to say this divided by 580 multiplied by 480 that we have more or less taken as a whole, and that will give me 826. The same thing I would do for the unlimited call time. At the end of the day, I'm able to apportion in this manner. And if I've done so, when we get to step 5, we'll come back to how then do we recognize revenue. But our objective in step 4 is how do we what? Allocate. And that's that. Any other question? Any other question?
Are we still going to treat any question that we addressed the last, the third method of allocation? And also, I want to look at this, your comments is equivalent of what competitors charge without giving free access. So it should be without.
Is without, yeah. Okay, we'll come back to step scenario 3 to recognize revenue once we get to step 5. Any other one before we move forward?
Yes, sir. Sorry, I don't really understand how you arrive at this value.
Which value?
Loan price approach, allocated price 82.76.
Yeah, it's a fraction now. We are saying that normally they're supposed to pay $100 for handsets, apart from $20 per month for calls. Now, impliedly, we say we are giving handset free. And that means that this 480 is more or less like you are giving discount that will reduce the cost of the handset from 100 to something. And what is the something is that invariably, this is the price you are selling the asset, and this is the total price of the call, which means the discount you are giving. The discount you deem to have given is the difference between the transaction price. This is the transaction price. Let me break it down. This is standalone price. Transaction price. And what? And the discount. Which means what you are doing is that you are not just giving, you are only giving discount on the purchase of assets, and you are also giving discount on the call time. That's what you've done. So that the amount of discount you are giving is a difference between this and this. Does that make sense? The $100 that you seem to have given out is given out on the basis of you giving $17.24 out from the price of the assets and $82.76 as discount from the normal call time. Does that make sense to you now?
Yes.
Okay. Now, let's go back to this. Okay, can somebody read this further for us?
Step 4, allocating the transaction price to performance obligations. The objective when allocating the transaction price is for an entity to allocate the transaction price to each performance obligation or distinct good or service in an amount that depicts the amount of consideration to which the entity expects to be entitled in exchange for transferring the promised goods or services to the customer. A combination of methods may need to be used to estimate the standalone selling prices of the goods and services promised in the contract if two or more of those goods or services have highly variable or uncertain standalone selling prices. For example, an entity may use the residual approach to estimate the aggregate standalone selling price for those promised goods or services with highly variable or uncertain standalone selling prices, and then use another method to estimate the standalone selling prices of the individual goods or services relative to that estimated aggregate standalone selling price determined by the residual approach. When an entity uses a combination of methods to estimate the standalone selling price of each promised goods or service in the contract, the entity shall evaluate whether allocating the transaction price at those estimated standalone selling prices would be consistent with the allocation objective.
Okay. Now let me try and find a practice question that also speaks volume to this. Now, you know, part of the accidental stuff I gave to you, I have something I can share with you on that again, and we'll buttress our point further. Okay, can somebody look at this for us? Over to you.
Okay, allocation methodology. An entity enters into a contract with a customer to sell products A, B, and C in exchange for 100 CU. The entity will satisfy the performance obligations for each of the products at different points in time. The entity regularly sells product A separately, and therefore the standalone selling price is directly observable. The standalone selling prices of products B and C are not directly observable. Because the standalone selling price for product B and C are not directly observable, the entity must estimate them. To estimate the standalone selling prices, the entity uses the adjusted market assessment approach for product B and the expected cost plus a margin approach for product C. In making those estimates, the entity maximizes the use of observable inputs in accordance with IFRS 15, paragraph 78. The entity estimates the standalone selling prices as follows. Product A, the standalone selling price is 50 CU, directly observable. Product B, 25 CU, adjusted market assessment approach. Product C, 75 CU, expected cost plus margin approach. The total standalone selling price is 150 CU. The customer receives a discount for purchasing the bundle of goods because the sum of the standalone selling prices of 150 CU exceeds the promised consideration of 100 CU. The entity considers whether it has observable evidence about the performance obligation to which the entire discount belongs in accordance with IFRS 15, paragraph 82, and concludes that it does not. Consequently, in accordance with IFRS 15, paragraph 76 to 81, paragraph 76 and 81, the discount is allocated proportionately across product A, B, and C. The discount and therefore the transaction price is allocated as follows. Product A, 33 CU, that is 50 CU divided by 150 CU times 100 CU. Product B, 17 CU, that is 25 CU divided by 150 CU times 100 CU. Product C, 50 CU, that is 75 CU divided by 150 CU times 100 CU. The total is 100 CU.
Now, this also shows you that in practice, you can use a crop of these methodologies, but there are conditions that is much more considered before making use of this. But take note, like in the one we just did, residual value is going to be used only when the restriction condition is no longer available. And that's why if you come back to my discussion here, I said, note that restrictive criteria must be met for the residual value or the residual approach to be used, which means with the information I have here, with the information I have in my Excel model, let me go back to the Excel model, with respect to the fact that I have information that says that the $20 is what may have been charged in the market. Therefore, I will no longer be able to use residual because residual approach only comes into play whenever the standalone approach, the adjusted market assessment approach, and the expected cost plus margin approach are not available.
Okay.
Take notes. Which means it's like the last resort if any of those fundamental ones are not observable or are not available in that case. Does that make sense? Okay, let's go back. And that is it, which means a mix of it can be put to use. Now let's look at how we can allocate a discount. You know, I've shown you an example of discounts. Okay, like discount should have been used proactively, but again, in the example I showed earlier, which I'll share again, I call it accidental scenario. This scenario, you could see that we didn't allocate it in the way you'll have expected. Okay, because we are able to establish that the discount, what was established, let me put it the observation. The series of the bundled pricing revealed that the presumed discount or deemed discount of $20 can be attributed to encouraging customers to purchase products A in combination with any other products. Or products. Hence, the discounts will solely be applied to products A. Does that make sense, please?
Yes.
Okay, now let's go back to discount to see it more in an elaborate fashion. Okay, Nodin, can you proceed with this?
Allocation of a discount. When the sum of the standalone selling prices of the goods and services promised in the contract exceeds the promised consideration in a contract, the customer has received a discount for purchasing a bundle of goods or services. This discount should be allocated proportionately to all performance obligations in the contract, unless there is observable evidence that the entire discount does not relate to all performance obligations in the contract. IFRS 15, paragraph 81. A discount is allocated entirely to one or more, but not all, performance obligation in the contract, and all of the following criteria if all of the following criteria are met. A.
Okay, let's wait there. Let's wait there. Huh? Thank you. Now, primarily, discounts that is applied to a bundle should are being allocated proactively on the basis of a standalone price for all the products that contributed to that bundle. But there are some criteria that if they exist, it then change the narrative, similar to the one we did in our accidental scenario. And that's where I want you to focus on. Can you continue from there now? Start again. A discount is allocated.
A discount is allocated entirely to one or more, but not all, performance obligation in the contract if all of the following criteria are met. IFRS 15, paragraph 82. A, the entity regularly sells each distinct good or service or each bundle of distinct goods or services in the contract on a standalone basis. B, the entity also regularly sells on a standalone basis a bundle or bundles of some of those distinct goods or services on a standalone basis at a discount to the standalone selling prices. And C, the discount attributable to each bundle of goods or service described in B is substantially the same as the discount in the contract, and an analysis of the goods or services in each bundle provides observable evidence of the performance obligation or performance obligations to which the entire discount in the contract belongs.
Now, that clarifies it. Okay. Now, let's also look at a situation where you allocate a discount to a single performance obligation, similar to the accidental scenario I did. Now, you have at least 3 performance obligations, but you only allocate to 1. You didn't even allocate to the 2. Okay, what will have formed that decision? Okay, can you proceed?
Allocation of a discount to a single performance obligation. It is possible for a discount to be allocated entirely to one of several performance obligations within a contract, but only in rare circumstances and with strong evidence to support that conclusion. Typically, the criteria in IFRS 15 paragraph 82 will be met only for contracts in which there are at least 3 performance obligations when a contract includes more than 2 performance obligations. The entity may be able to demonstrate that the discount relates to a subset of performance obligations and therefore allocate the discount only to the performance obligations in that subset. Nevertheless, IFRS 15, paragraph BC 283 notes that if it may be possible for an entity to have sufficient evidence to be able to allocate a discount to only one performance obligation in accordance with the criteria in IFRS 15, paragraph 82, although the board expected that this could only occur in rare cases.
Okay, thank you very much. Now, that is that. And let us look at a practical scenario that more or less speaks to the same thing I've modeled earlier, but from the perspective of the standard. The standard gave illustrative guidance. Let us look at exactly the illustrative guidance given by the standard. Okay, Shagun, you can try this.
Allocation of a discount to a single performance obligation. Example, entity Z regularly sells items A, B, and C on a standalone basis for the following prices. Item A, 10 CU, item B 47 CU, item C 38 CU. The following bundles are also regularly sold by entity Z at the end at the following combined prices. Items A, B, and C at 92 CU, combined standalone selling prices 10 CU plus 47 CU plus 38 CU, and a discount of 3 CU. Items A and B goes for 54 CU, combined standalone selling prices are 10 CU plus 47 CU, which is equals to 57 CU plus 3 CU discount. Items A and C goes for 45 CU, combined standalone selling prices 10 CU plus 38 CU, which is equals to 48 CU, discount of 3 CU. Items B and C equals to 85 CU, combined standalone selling prices 47 CU plus 38 CU, which is equals to 85 CU, and there is no discount. Entity Z considers whether the three criteria in IFRS 15 paragraph 82 are met, such that the discount of 3 CU, which arises when item A is sold, is a bundle with either or both of item B or C, can be allocated entirely to item A. In particular, Entity Z concludes the criteria in IFRS 15 paragraph 82 are met because, one, the same discount is given whenever the item is sold along with others from a range of possible items, and two, the discount does not arise when a combination of other items is sold. Therefore, Entity Z allocates the discount of 3 CU to item A when it is sold in a bundle with either or both of item B or C.
Did you get it now? Can you continue? That is one scenario. Okay. This is the scenario we just finished.
Okay.
Okay. Now, let's look at each case of those scenarios. Okay, can you proceed?
Okay, sir.
This is another scenario you could look out for. Okay, can you look at it?
Allocating a balance. An entity regularly sells product A, B, and C individually, thereby establishing the following standalone selling prices. Product A for 40 CU, product B for 55 CU, product C for 45 CU, with a total of 140 CU. In addition, the entity regularly sells product B and C together for 60 CU. Case A, allocating a discount to one or more performance obligations. The entity enters into a contract with a customer to sell products A, B, and C in exchange for 100 CU. The entity will satisfy the performance obligations for each of the products at different points in time. The contract includes a discount of 40 CU on the overall transaction, which would be allocated proportionately to all three performance obligations when allocating the transaction price using the relative standalone selling price method in accordance with IFRS 15 paragraph 81. However, because the entity regularly sells product B and C together for 60 CU and product A for 40 CU, it has evidence that the entire discount should be allocated to the promises to transfer products B and C in accordance with IFRS 15 paragraph 82. If the entity transfers control of product B and C at the same point in time, then the entity could as a practical matter, account for the transfer of the products as a single performance obligation. That is, the entity could allocate 60 CU of the transaction price to the single performance obligation and recognize revenue of 60 CU when products B and C simultaneously transfer to the customer. If the contract requires the entity to transfer control of product B and C at different points in time, then the allocated amount of 60 CU is individually allocated to the premises to transfer product B, standalone selling price of 55 CU, and product C with standalone selling price of 45 CU as follows. Product B, which is 35 CU, the allocated transaction price will be 55 CU divided by 100 CU, total standalone selling price times 60 CU. Product C of 27 CU, the allocation transaction price will be 45 divided by 100 CU, that is total standalone selling price, times 60 CU, which will bring us to a total of 60 CU.
Okay, thank you very much. Now, you asked a question that the residual value, or sorry, the residual approach, when can it be used and how can we make use of it? Now, you see it practically as demonstrated in the standard. When and how is residual approach considered appropriate and put to use? Now let's look at that. Can you read it up?
Case C, residual approach is appropriate. The entity enters into a contract with a customer to sell products A, B, and C as described in case A. The contract also includes a promise to transfer product D. Total consideration in the contract is 130 CU. The standalone selling price for product D is highly variable because the entity sells product D to different customers for a broad range of amounts from 15 CU to 45 CU. Consequently, the entity decides to estimate the standalone selling price of product D using the residual approach. Before estimating the standalone selling price of product D using the residual approach, the entity determines whether any discount should be allocated to other performance obligations in the contract in accordance with IFRS 15, paragraph 82 and 83. As in case A, because the entity regularly sells products B and C together for 60 CU and product A for 40 CU, it has observable evidence that 100 CU should be allocated to those three products and a 40 CU discount should be allocated to the premises to transfer products B and C in accordance with IFRS 15, paragraph 82. Using the residual approach, this entity estimates the standalone selling price of product D to 30 CU as follows. Product A has a standalone selling price of 40 CU, and the method is directly observable. We use directly observable approach. Products B and C has standalone selling price of 60, and we also use directly observable with discounts approach. Product D has a standalone selling price of 30 CU, and we use the residual approach to arrive at a total of 130 CU. The entity observes that the resulting 30 CU allocated to product D is within the range of its observable selling prices of 15 CU and 45 CU. Therefore, the resulting allocation is consistent with the allocation objective in IFRS 15, paragraph 73, and requirements in IFRS 15, paragraph 78.
Now, can you see the restrictive condition or criteria that seems to be met? That is why residual approach can ever be adopted, which means it's only when is the only option available for that situation and that it met the requirements of the restrictive criteria. That is only when you can do that. Now, I'll also show you when that residual approach may want to be put to use, but is inappropriate. Let us look at it. Can you look at a scenario where it's inappropriate?
Okay, case B, residual approach is, okay, no, not yet. Is appropriate is what I'm saying here.
Case C. Okay, hold on.
Okay, case C, residual approach is inappropriate. The same facts as in case B apply to case C, except the transaction price is 105 CU instead of 130 CU. Consequently, the application of the residual approach would result in a standalone selling price of 5 CU for product D. 105 CU transaction price less 100 CU allocated to products A, B, and C. The entity concludes that 5 CU would not faithfully depict the amount of consideration to which the entity expects to be entitled in exchange for satisfying its performance obligation to transfer product D. Because 5 CU does not approximate the standalone selling price of product D, which ranges from 15 CU to 45 CU. Consequently, the entity reviews its observable data, including sales and margin reports, to estimate the standalone selling price of product D using another suitable method. The entity allocates the transaction price of 105 CU to products A, B, C, and D, using the relative standalone selling prices of those products in accordance with IFRS 15, paragraph 78 to 80.
Okay, thank you. Now, have you ever seen a situation where if you will buy a product A, you buy it for $100. You buy product B, $80. You buy product C, $20 on a standalone basis, which means in all, it is $200 if you buy it individually. But that product is bundled in a package where it's the same A, B, C that is put together in that package and is labeled premium package, labeled diamond package, labeled platinum package, or any name you could give to it. And the price of it as a bundle is $210. Did you get my message?
Yes.
Individually, if you buy A, $100, you buy B, $80, you buy C, $20, which means if I buy the three one by one, I'll pay $200. But they are now put together, exactly the same thing put together, and they call it platinum package. And it is sold for $210.
I won't buy it.
No. They are not targeting you. They call it platinum. Probably you don't belong to platinum or diamond. Probably you belong to silver or gold or bronze. Now the question is, that is the price they sell, $210, and people still buy. The question then is, how do we allocate the premium or surplus when we are allocating the transaction price? Okay, you also do us a favor. Who will do us a favor now? So anybody can volunteer now. Allocation of a premium or surplus. How do you go about it? Madam Grace? We can't hear you. Can you assist us?
All right, so allocation of premium or surplus. As noted at 8.3, when the sum of the standalone selling prices of the individual performance obligations in a multiple element arrangement exceeds the promised consideration. IFRS 18, paragraph 81 requires any discount under the contract to be allocated proportionately to all performance obligations unless an entity has observable evidence that the entire discount is related only to one or more, but not all of the performance obligation in the contract. IFRS 15, paragraph 82 specifies the criteria an entity is required to meet to conclude that the discount does not need to be allocated proportionately to all performance obligations. IFRS 15 does not, however, explicitly discuss situations in which a promised consideration in a contract exceeds the sum of the standalone selling prices of the individual performance obligations, which would suggest that a customer is paying a premium for purchasing the goods or services. Although such situations may not be common, they can arise when, for example, an entity sells its goods or services for a broad range of amounts. In such circumstances, an apply the adjusted market assessment approach described in IFRS 15, paragraph 79, to each performance obligation in the contract, which could result in a determination that the total transaction price of the contract exceeds the aggregate value of standalone selling price of those goods or services. This scenario is expected to be relatively uncommon, and before assessing how to allocate an apparent premium, an entity should consider the potential that an error such as one of the following has been made in the analysis. 1, a significant financing component in the contract has not been identified. 2, the contract includes an incentive, that is performance bonus, that has not been identified. 3, additional performance obligations have not been identified. Or 4, the standalone selling price of performance obligations have not been correctly identified. If, after further assessment, it is determined that a premium exists, the entity should allocate the premium in a manner consistent with the requirements of IFRS 15 for allocation of a discount, that is, on a relative standalone selling price basis in accordance with IFRS 15, paragraph 74. See 8.1, subject to the exception in IFRS 15, paragraph 81 to 83.
Okay, thank you very much. Thank you very much. Okay, now we will venture into the last step. And the last step deals with recognition of revenue when or as a performance obligation is satisfied. And we're going to look at that, where we'll be able to establish whether revenue is to be recognized at a point in time or it should be recognized over time. Now, let's look at our slide. Now, the transaction price is expected to be allocated.
Please, can you share your slide, sir?
Which is in step 4. After the allocation, okay, after the allocation, I've not shared the slide now. After the allocation, okay, I've done that. After the allocation, the last phase of the model is to recognize revenue in our profit or loss. And the question is, what amount of revenue out of the transaction price so allocated should we recognize in our books for the accounting period in question? And we said it is the function of is such a revenue arising from goods or services that have been delivered and consumed. What does that mean? If the revenue is associated with you delivering on a performance obligation that deals with sale of goods, that means and you have transferred the control of that good to the customer. Or it deals with you rendering a service, and that service has been deemed to have been rendered completely at once, like let's say Uber. You've taken the Uber and the Uber has dropped you in your spot, which means you have consumed that service as a whole. In that situation, revenue is deemed to have been recognized at a point in time, or should be recognized at a point in time. Conversely, if the nature of the good or of the service is something that takes substantial period of time, to which the entity consumes such goods or services over a period of time. Therefore, revenue associated with such a contract should equally be recognized over time. Example is this. You engage a professional firm on a job, which will take an average of 3 months. And in your agreement, they define the scope. You define the scope, and they define the timeline and the phases to delivering on the scope. And you have agreed in your contract that this contract of 3 months has 4 phases. And each phase, upon completion, they are entitled to receiving 25%. It then means that as a complete phase 1, even if phase 2 is still ongoing, the firm would proceed to recognizing revenue of 25% of the allocated transaction price. And by the time they complete phase 2, they recognize the next one up to the complete phase 4, which means such scenario depicts that revenue is recognized over time. And that is that. And that is the position that we are looking at. The standard went further to give us a guidance that a customer is deemed to have been satisfied, in which you can proceed to recognize revenue only when control of the promised goods or services has been transferred to the customer. And that will have been defined in your contract. Let me give you an example. When it comes to purchase of goods in another country, there are this agreement that might say, free on board. Or what we call FOB. What that might presupposes, if no other condition is attached, is that once the foreign supplier has delivered the goods into ship, that foreign supplier will have been deemed to have satisfied the performance obligation with respect to delivering the promised good to the customer. In that situation, even when the customer has not gotten the good at the other side, the agreement is that from the point of origination, once I deliver it and you have received your bill of lading, therefore, I have satisfied all conditions incidental to sale of that good. Okay. Now, the standard went further to identify in practical terms, how do we know or establish that satisfaction has been enjoyed with respect to the promised good or service by the customer? It says one, when you are able to establish that the customer has the ability to direct the use of an asset or the good involved, it then means that control of such an asset has moved or has been transferred from the entity to the customer. Furthermore, it is also established that the ability to obtain substantially all the remaining benefit of or associated with that asset, once it is established that it resides with the customer, in that situation, it will be deemed that the control of the asset has equally been transferred to the customer. Now, the standard identifies about 5 factors that demonstrated, which means it's not necessarily that all, but substantially more of these factors establish that control may have been transferred from the entity to the customer. And what are these factors? The first one borders on the fact that if the entity immediately, as a result of what he has done, has a present right to receiving payment with respect to that asset from the customer, that shows such an evidence. Furthermore, where the entity physically has delivered on the good, and the good is now in possession and control of the customer. Furthermore, if it has been deemed that as a result of the action of the entity, legal title has moved or transferred from the entity to the customer, in that light, it is deemed that the customer now has control of the assets. Another one is if substantially the risk and reward associated with the ownership of that asset or good resides or has been transferred to the customer. In that light, control of the assets has been transferred. And finally, if there's evidence of the acceptance of the good or asset by the customer as evidence, probably in writing by way of acceptance certificates, or impliedly by way of other means of communication, it also signifies that the promised good or service has been delivered by the entity. These are practical things that we need to take into consideration. Now, as a whole, we'll further look at certain commentaries that equally suggest as appropriate how we are going to proceed in the recognition of revenue. Now, remember, the phrase at a point in time means you recognize our revenue once because that performance obligation has been delivered. But over time means the performance obligation entails continued action of the entity in delivering on those performance over time. And therefore, on certain basis or method, you will now be recognizing portion of the transaction price associated with the performance obligation as revenue on a periodic what basis. How do we justify that? Let's look at further narratives. I want somebody to look at this further narrative and try to shape it for us. Over to you guys.
Recognition of revenue when or as a performance obligation is satisfied. The entity satisfies a performance obligation by transferring control of a promised good or service to the customer. A performance obligation can be satisfied at a point in time, such as when goods are delivered to the customer, or over time. An obligation satisfied over time will meet one of the following criteria. The customer simultaneously receives the goods, the customer simultaneously receives and consumes the benefits as the performance takes place. The entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. The entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. The amount of revenue recognized in the amount is the amount allocated to the performance obligation. The entity must be able to reasonably measure the outcome of a performance obligation before the related revenue can be recognized. In some circumstances, such as in the early stages of a contract, it may not be possible to reasonably measure the outcome of a performance obligation, but the entity expects to recover the costs incurred. In these circumstances, revenue is recognized only to the extent of costs incurred.
Okay, in addition to that, and much more skewed towards recognizing revenue over time, certain costs needed to be aggregated. The word aggregation of costs means you have to capitalize those costs. And what form of cost will you capitalize? If you remember our narrative yesterday, or in part one, we discussed about cost of obtaining a contract as against cost of fulfilling a contract. And when does a cost of obtaining a contract qualify for capitalization on the premise that it's aid in fulfilling a contract? Now, in doing so, I want you to look at this in addition. Over to you.
Contract costs associated with recognizing revenue over time. The incremental costs of obtaining a contract, such as sales, commission, are recognized as an asset if the entity expects to recover those costs. Costs that would have been incurred regardless of whether the contract was obtained are recognized as an expense as incurred. Costs incurred in fulfilling a contract unless within the scope of another standard, such as IAS 2, inventories, IAS 16, property, plant, and equipment, or IAS 38, intangible assets, are recognized as an asset if they meet the following criteria, according to IFRS 15, paragraph 95. A, the costs relate directly to an identifiable contract. Costs such as labor, material, management costs. The cost generates or enhance resources of the entity that will be used in satisfying or continuing to satisfy performance obligations in the future. And C, the costs are expected to be recovered. Costs recognized as assets are amortized on a systematic basis consistent with the transfer to the customer of the goods or services to which the asset relates.
Now, let's now look at the way to which we can recognize revenue over time, having identified that certain performance obligations are obligations that are satisfied over time. Obligations that are satisfied at a point in time usually relates to where you deliver goods or you render service, and that service is immediately consumed without any expectation of fulfilling future performance as regarding that service. But for things like construction contracts, for things like project management and etc., they are performance obligations that an entity is expected to perform over time. And therefore, such promised good or service will be delivered over time. The standard makes us to understand that in doing so, we then need to identify what is the appropriate methodology to attributing that transaction price for that performance obligation into various periods in which the performance has been satisfied and benefits consumed by the customer over those periods of service. And the standard came up with two methods, even though the standard is much more favorably disposed to the output method. There are two methods, the output method and the input method. The output method in its own form recognizes revenue much more on the basis of the value to the customer with respect to the goods and services that has been transferred to it. And that methodology includes appraisal value, market value, survey value, depending on what kind of contract is involved. Let me give you a practical example. A contract of construction of road, 10-kilometer road, based on our example in part 1. When you have gotten to 6 kilometers out of the 10, it may not be evenly distributed, the value of that contract. Why? Because it's not like the texture of the road are the same across that 10 kilometers. It might be the first 2 kilometers that got more cost because those are the places you have more critical issues. You have to excavate pipelines. You have to do this, you have to do that. The texture of the land, based on your soil test, shows that you have to evacuate some other soils and bring in the red soils and some other things like that. While in some other part, it's much more something you just grade. Therefore, on that basis, the most appropriate methodology will be like the output. And what does the output say is that you get an independent, probably you call it a surveyor, an expert, a valuer, who will issue a survey certificate or value certificate to say, based on the demonstration of work done so far, and up to the phase that has been agreed as a concluded phase, the value so satisfied on this contract or on this work done is so much. And that value will serve as a basis to recognizing revenue based on what we call the output method. Whereas, conversely, the input method will rather recognize revenue on the basis of the costs that the company or the entity has incurred with respect to the input resources. How much of materials have we used? How much of labor have we used? How much of other resources have we used? What is the aggregate cost that has been incurred? That is one. What is the cost we expect to incur in future to fulfill the remaining of that construction? And you will now look at it that if I've incurred 10 to finish 6 kilometers, and I'll incur 5 to finish the 4 kilometers, it then means 15 is my estimated cost to complete, my estimated total cost, of which 10 of that 15 is my actual cost incurred to date. The 5 is my estimated cost to completion. I'll now use that ratio of 10 to 5 to more or less determine the portion of the transaction price which has been so allocated to that construction contract to recognize the revenue. And that is synonymous to what we call the percentage of completion method that we know under IAS 11. And that method is synonymous to what we call the input methodology. Okay, on that premise, I want us to look at this. And later, we'll look at some exercises. Can somebody read this for us?
Okay, performance obligations satisfied over time. When a contract contains a performance obligation satisfied over time, an entity often has an enforceable right to pay for the performance completed to date. The standard describes this as an amount that approximates the selling price of the goods or services transferred to date. For example, recovery of the cost incurred by the entity in satisfying the performance plus a reasonable profit margin. Methods of measuring the amount of performance completed to date encompasses output methods and input methods. Output methods recognize revenue on the basis of the value to the customer. Output methods recognize revenue on the basis of the value to the customer of the goods or services transferred. They include surveys of performance completed, appraisal of units produced or delivered, etc. Input methods recognize revenue on the basis of the entity's inputs, such as labor hours, resources consumed, cost incurred. If using a cost-based method, the cost incurred must contribute to the entity's progress in satisfying the performance obligation.
Now let's look at an illustration with respect to a construction contract. Now, can somebody read this question and let's attempt solving it? Can somebody volunteer to read the question?
Illustration. Suppose that a contract is started on 1st January 20x5 with an estimated completion date of 31st December 20x6. The final contract price is $1,500,000 in the first year to 31st December 20x5. A, cost incurred amounted to $600,000. B, half the work on the contract was completed. C, certificates of work completed have been issued to the value of $750,000. D, it is estimated with reasonable certainty that further cost to completion in 20x6 will be $600,000. What is the contract profit in 20x5? And what entries would be made for the contract at 31st December 20x5?
Okay. Now let's open a model for it. Okay. Now, let's look at it. Contract start date. 1st of January, 2015. Completion date, estimated completion date. December 2016. That means expected period of construction in years. Remember, I can use exact dates, the difference between these two dates in years. Y stand for year. It's telling me 1 year, no? Okay, it's because of this is 2 years exactly. Okay, let me just say this date is same thing as 1st of January, 2017, which is 2 years. At first, we hand over the sites on 1st of January, which is the same thing. Okay, 2 years. Furthermore, what other information? We have actual cost to date. Actual cost incurred to date, $600,000. Half the work has been done. Progress to date in percentage, 50%. Certificates of work completed are being issued, which means survey value of work done and certified. How much? 750. Now, it is estimated with reasonable certainty that further cost to completion in 2016, 600, which means estimated cost to completion as determined at 31st December 2015. Remember, this date, 2015, was when this assessment is done. And that was said to be 600. Now take note. By nature of this contract, they believe that the same spectrum of what they are doing are equal. That's why you find out that 15% progress has consumed 600,000. The remaining 50% also is expected to consume 600,000. But that is not usually the case in all contracts. Now, the question then is, what is the contract profits? What is the contract profit is a function of two things. as at 31st December 2015 is a function of the methodology adopted. We are going to look at the methodology one by one. What are the methodologies? A, the output method. B, the input method. Now, but before then, step one is to, as at 31st December 2015, estimate the total profit on the contract. How do you do that? Estimating the total contract is a function of what is the contract price, transaction price? This is the transaction price over a 2-year contract. And what is it? The contract price is contract price, which is simply as the transaction price. $1.2 million. Therefore,
I don't think it's 1.2 million, it's 1.5.
okay, sorry, 1.5. Thank you. Okay, let's the estimated total contract cost. And one of it is actual cost incurred to date, and 2 is the estimated total contract cost. Actual cost to date is 600. Estimated cost to completion is also 600, which means all in all, is 1.2. And this is our total contract profit we expect is estimated total contract profit as per information available as at 31st December 2015. Therefore, the question is, of this 300, how much is our profit? And profit is a function of revenue and cost. Therefore, what do I need to do? I come here and say, output method will say my revenue less my actual cost. Now, my actual cost is known. My actual cost as at 2015 is 600. Okay. But my revenue is to be determined as shown below. Now we determine that under the output method. Is for us to say my revenue is a function of the value of work done and certified by independent valuer as contained in the contract. And that is an industry of its own. You know, there's international standard on valuation for contract of construction and services. And that is another field. That is not our own field. Therefore, we will rely on the work of another expert. IFRS will not tell you how to verify that. That is not us. They too have their own standards and basis of verification. But as accountant or auditors, you will rely on it to a certain degree. Therefore, and in this case, it is certified for how much? For 750,000. Therefore, I'll come here to recognize 750,000 as my revenue. Okay, at the end of the day, what is my profit? 150. But if it's the output method, what will I do? For the output method, my actual cost is still 600. But the output method will determine, sorry, the input method will require a percentage of completion as thus. The percentage of completion is equivalent to the ratio of the actual cost incurred to date to the estimated total cost of completing the contract as at the reporting date, which is 2015. And what that presupposes is that We pick the actual cost to date, which is 600, as a ratio of this estimated total cost. 600 plus 600. And at the end of the day, what is the percentage? Percentage is 50%. Now, please be careful, and I'll show you something. Because it's a model, it will expose where we need to be careful of. This 50% looks the same thing as this 50%, but they are not the same thing. You have to be very careful. Why? This 50% is based on, let me say, kilometers of the road. You've done half of the kilometer. 10 kilometers, you've done 5 kilometers. And that is this 50% progress. But this 50% here is with respect to cost. And where the demand of work varies along the kilometer, it won't be the same. Supposing it's at the start of the kilometer that you have to excavate pipeline, and you have to incur costs, do all sorts of things in that. Even though you have just completed 5 kilometers out of 10, doesn't mean the cost will be the same, because the remaining 5 kilometers are just very smoother road in which it will not take you more time and resources. Therefore, this will not be the same. And how we will know is that, imagine our estimated cost to complete the remaining half is 450 as against 600. You'll find out that this is showing 57, whereas this is still 50 because we have just done half. Am I making sense? Let us take note of that. Okay, that is that. Now, this percentage is what will now be used to determine revenue. Revenue will now be equal to the percentage of completion multiplied by transaction, or what you call the contract price. And in that case, it is 50% multiplied by the 1.5. And that's how much? 50% multiplied by the contract price. And that's 750. Okay, and from there, I can link my 750 to this. Take notes. Let me reference it. Note 1. Therefore, I'll call this note 1. Note 2. I'll reference it. Note. Please take notes. Now, as I've said earlier, let me say this is 450. You now find out that the revenue is not exactly the same. The certified method still shows 750, while this is showing 857. And you must take note of that. Okay. Now take note, year 2 should take the remainder of the profit. That is on the expectation that the estimated cost is exactly the actual cost in year 2. But you know that it will not necessarily be exact, but it might be a close approximation of it. Does that make sense? Does that make sense to anybody?
Yes, it does. It makes sense.
Okay.
Yes, sir.
Now, yes, sir. Yes, I can hear you. Hello. Okay, now let's read this summary to justify some of the things we've done. Over to you guys. Who will read?
Solution. This is a contract in which the performance obligation is satisfied over time. The entity is carrying out the work for the benefit of the customer rather than creating an asset for its own use. And in this case, it has an enforceable right to payment for work completed to date. We can see this from the fact that certificates of work completed have been issued. The amount of payment that the entity is entitled to corresponds to the amount of performance completed to date, i.e. goods or services transferred, and the revenue recognized relating to the performance obligation. In this case, the contract is certified as 50% complete, measuring progress under the output method. And at 31st December 2025, the entity will recognize revenue of $750,000 and costs of sales of $600,000, leaving profit of $150,000. The contract assets will be the revenue recognized to date, that is $750,000. We are not told any of these amounts has yet been invoiced, so none of this amount is classified as receivables.
Okay. We are still going to come back to distinguishing between contract liability, contract assets, and receivable. But to move further, I'll give you another scenario that we all more or less play with. Another illustration. I want somebody to read it out for us. Illustration.
Can I ask a quick question?
Yes, sir.
Okay, you listed the criteria that must be met for revenue to be recognized. That is when
Yes.
the goods have been transferred, when, legal control and all those things. For control to be established. Now, those 5 items that you mentioned, must all of them be satisfied or just 1 or 2?
Okay, I said in substance, significant part of those things should have been met or visible in the action that has occurred. Are you getting what I'm saying now?
Okay.
And therefore, it's not that the all 5 must be there at the same time, but remember, it is the overall substance that matters, not necessarily the count. The only time all conditions must be met is if explicitly in the standard such is provided. For example, at the beginning, when we are identifying the contract, the standard identifies 5 criteria that must be met. And we explain them at the start of the section. In that case, the standard was explicit. In other cases, the standard will say, once you have one or combination of more of these factors, it seems this exists. That is a separate situation. Do you get what I'm saying now? Any other question? Okay. Okay, let's look at another illustration. Can somebody read this illustration to us?
Illustration 2. PICO has the following contracts in progress. All figures in $1 million. Total contract price, 750. Cost incurred to date, 225. Estimated cost to completion, 340. Payments invoiced and received, $290 million. PICO uses the input method to measure satisfaction of performance obligation based on cost incurred as a proportion of total expected cost required. Calculate the amount to be recognized for the contract in the statement of profit or loss and statement of financial position.
Okay, thank you. Now let's switch to our exam model sheet workbook. Now this is a question. Okay, now let's check information that is relevant. Did you give us start date or end date? Those are not relevant here. Now, let me shift this upward. What is our total contract price? Total contract price is 750 million. All figures in millions. Note. All figures in millions of US dollars. Let's take note of that. Cost incurred to date, 225. Estimated cost to completion, 340. Issue of progress was not given. Therefore, it's not relevant. Estimated cost to completion, yeah. Payment invoice. Let me change this one to payment. Okay, that's payment. Payment invoice and received. That is 290. Okay. I don't know the date. Let me just say as at the reporting period. Okay. Now, all things we need, we don't need the output method. We don't need the output method. Therefore, I can take my input method up. Okay, now, as at the reporting date, our estimated total profit is the contract price, total contract price, less estimated total contract cost. Okay, which is actual cost incurred to date and the estimated total contract cost. Now, that sum up to 565, which speaks to the fact that 185 is the total profit as a whole. Okay, but based on the input method, revenue will be determined with reference to the note. Now, what is revenue? Revenue is a function of the percentage of completion. How? What is the actual cost? The actual cost is 225. Okay? Whereas the estimated total cost is 565. Now, it means 40% of the job has been computed based on the input that is required to complete the job. Therefore, 40% of the revenue should be recognized. Therefore, I need to recognize 40% of the revenue, which means 40% of the 750 million. Will be recognized. Now, in that light, what has happened? We recognize this. And at the end of the day, what we have recognized is 73.67. Okay. Now, everything we are using here, we are using it based on the not by approximation. Okay. Now, at the end of the day, what are we told to do? We are told to do what? Calculate the amount to be recognized for the contract in your statement of profit or loss and your balance sheet. Now, this addresses our profit or loss. Let me bring the note down. This aspect deals with my statement of profit or loss, or my income statement is an extract. Now my balance sheet. Now, in my asset section, I may have two components, and the two components lies within current assets, if any, and I will explain. And the items are contract assets and receivables. I'm putting them in order of permanence. And in current liability, let me put this note here. Let me write the actual amount, 39.82%. Okay. Now I have liability section. Also within liability section, I have current liability, if any, for contract liability. Now, in this question, let's look at what has happened. What is a contract asset? If we go back to one of our discussions, where's our notes?
So if I can just speak to that contract assets.
Yeah.
Yeah, like it's the amount receivable from the contract, but for which the receivable is based on the performance of certain aspects of the contract. I don't know if I've defined it very well.
Okay, I think you are trying to define. Don't try to define, try to explain it.
Okay.
Okay.
So
Try to explain it.
It is what the contractor will receive from the contract which he has already performed. But for him to be able to receive that amount is still dependent on certain aspect of the project that needs to be completed.
Therefore, in a clear term, what is a contract asset? In a clear term, what is a contract asset? Now, let me refresh our memory so that I can compare it explicitly. Now, the standard defined contract asset as when an entity has a right to consideration in exchange for the goods or services that the entity has transferred to the customer, when that right is conditioned on something other than the passage of time. Now, what does that mean? In this question we are trying to solve, you can see now, a contract asset will be much more represented by the portion of what the entity might have been entitled to, but cannot yet receive or is not yet due until the entity has finished that phase of work. I'll give you an example. You have done, you divide a contract into 2 phases, but you can only bill at the end of each phase, regardless of what you have done. Now, by the end of the year, I've finished phase 1 totally, and I've even done 20% of phase 2. But I can't bill both phase 1 and part of phase 2. No, I can only bill phase completed. The portion of the phase completed that I bill, if it's 10 million, but all what I've done so far, including 20% of phase 2, is 12 million. Therefore, the 10 million that I have completed and have billed will be deemed to be receivable if it has not been paid. While the 2 million that I have done, but it's not yet due for me to bill, it is a contract asset because I still have right to collect it, but until I finish phase 2, that I can collect it along with other part of phase 2 that has been completed. Does that make sense?
Yes.
Okay. Therefore, let us ask ourselves a simple question. How much has been built? So what is the actual work done? Actual cost incurred to date. All what you have incurred to date was 225. Is that not? Are you getting it?
Yes.
Okay. Therefore, if you have done this up to date, 225, cost incurred to date, and you have built 290, this is just the cost you have incurred to date. How much is your profit earned to date? Because you are not charity. Cost you incur is what you have paid on behalf of the customer, material, labor, and etc. But my own sweat, which is the profit, why I've labored, I also have to consider it. And how much is that? It's 73. At the end of the day, the total amount deemed to have been earned on that is 298. The question then is, of that 298, less amount that has been invoiced. Less amount that has been what? Invoiced. Now, how much have I invoiced? How much was invoiced?
290.
Two what?
290.
290. Therefore, how much is left? That I've done something for it, but I can't bill. That amount is what we call the contract assets. This is a contract asset. In simple terms, I can say this means value of work done but cannot be billed yet. This is the value of work done, but cannot be billed what? Yet. That's what it means by contract asset. And I'll come here to say my contract asset is so much. Now, what is my receivable? What is the definition of receivable? We'll go back. Receivable entails when an entity has a right to consideration that is unconditional other than passage of what? Time. And therefore, what is receivable is the amount outstanding from your invoice. Which means, what is the amount invoiced? Amount invoiced How much did you invoice? You invoice what? 290. How much have you received? Less amount what? Received from customer. How much have you received from customer?
290.
It's still the same 290. What is your receivable? What is your receivable? What is your receivable?
New.
Your receivable is what?
New.
Is nil.
Zero.
Now, there's a thin line between your receivable and your contract liability. And we're going to see it later. But in this question, our receivable is nil. Okay, now what is our contract liability? Our contract liability entails when an entity has an obligation to transfer goods or services to customer for which the entity has received consideration, or that amount will later be due to customer when you are unable to fulfill that future performance. Now, let me explain. From the same analysis we are doing. Imagine you build 290, but you receive 200. What do I have? I have a receivable of what? 90. Positive, have you? But if you build 290 and you receive 350, what do you have? You have a contract liability. What does that mean? It means apart from the customer paying you 290 that you have invoiced, the customer is also mobilizing you ahead of performing other promised services so that you can use that 60,000 to fast track the work or to do the job, which means such is a contract liability, which requires you to fulfill other performance in order for you to earn that 60. Does that make sense to you? Does that make sense to you?
Yes.
Which means the person pay you what you have invoiced, still pay you something in excess of it. Okay, now somebody will have said, okay, this 60, why can't I offset it with this 8? You can't offset it, or you may not offset it. And the standard favors you more to recognizing contract assets separately from contract what? Liability. Okay, but there are also general conditions towards offsetting asset and liabilities. One of those conditions is that where there's a legally enforceable right, and secondly, when by principle or practice, the assets will be realized to settle the liability, or there is a right to offsetting it, both the asset and liability. And therefore, that is that. But in this question, there is no contract liability, neither is there receivable, because everything zero off. And therefore, I'll come here. If this is positive, that is greater than equal to 0, return the value. Otherwise, return nothing. or return 0. And for contract liability, if this is greater than equal to 0, return 0, otherwise return, what is here? Negative of what is there. Now, what it means is this: if I come back here and I say this is 200, it will only report it as receivable. But if I say it is 350, it will report as contract what? Liability. That's what I've done. Okay, which means I can sum this up as asset. And I can sum this up also. Okay. That is that. Now let me return it back to 290 it was. Okay. That is that. Does that make sense to us now? Any question on this? Any question on this? Now, I'll give us another exercise.
Yeah, hello, Mr. Muiwa.
Yes, sir.
Yeah, please, can you just give us assignments?
Okay.
We need to, we want to make a provision for tomorrow.
Yeah, don't worry, we'll give you assignments.
Okay.
That's not an issue. We'll give you assignments. Okay?
Yeah.
Okay, now let's look at this problem and let's try and solve it. Let somebody volunteer to read the question and I will attempt guiding you through the solution, through the model we've developed.
Okay, illustration. The main business of Santolina Co. is building work. At the end of September 2023, there is an uncompleted contract on the books, details of which are as follows. Date commenced 1st April 20x1. Expected completion date 23rd December x3. Figures in dollars. Total contract revenue $290,000. Cost to 30th September x3 $210,450. Value of performance obligations satisfied to 30th September x3 $230,000. Amount invoiced for work certified to 30th September X3, 210,000. Cash received to 30th September X3, $194,000. The contract is expected to be profitable on completion. In a separate transaction, Santolina Co. transferred inventory of bricks to the customer on 30th September 2023, in which the customer plans to use in another contract that Santolina Co. will not be undertaking. The bricks cost Santolina Co. $10,000 and were sold to the customer for $14,000 on credit. Required: prepare calculations showing the amounts to be included in Santolina Co. statement of profit or loss and statement of financial position at 30th September 2023 in respect of the building contract and the sale of bricks.
Thank you. Now let's look at the question from our model here. Now, based on the information available, which methodology do you believe is appropriate? Is it the input method or the output method? And why?
Okay, for me, I will go with the output method. Simply because we have all the variables to use an output method, which includes the value of performance obligation certified to date. And I will not use the input method simply because though I have the cost to date, but I don't have the total costs to satisfy the projects. So there's no basis for me to use the input method. Hence, I go with the output method.
Okay, thank you very much. I think that clarifies it. The next question is, how many performance obligations exist in the contract based on information available as at 30 September 2013? Who can answer that?
I believe we have two.
Okay, at the inception of the contract, how many do we have at the inception of the contract?
At the inception of the contract, we had just only one performance obligation.
Which is construction.
Construction, yes.
Of an asset. Have you?
Yes.
Okay. Now, but as at end of the year, revelation came in that we have another performance obligation that may have been agreed with the customer. And what is that?
Supply of bricks.
Supply of bricks. Now, if you look at these two contracts, are they to be recognized at a point in time or over time, or how should we recognize them? Construction of assets. Okay. Since it takes a substantial period of time to complete and it spans for more than one accounting period, how are you to recognize the revenue? Is it over time or at a point in time?
It's over time.
Over time. The supply of bricks, are you to recognize the revenue over time or at a point in time?
This one at a point in time.
At a point in time. Why?
Yeah, because the delivery of the contract, of the goods is immediate. It's not spread over a particular time.
because the promised good is received and nothing else is expected to be performed in the future. Okay, but for the construction of assets, even though you've met phase 1, duly completed and certified, but you still have future performance in order to fully complete the project. And therefore, that is over time. Let's take note of that. Now, let's move ahead. Now, how do we recognize? What would be the revenue you recognize? What is your revenue? What is your revenue you recognize at the end of the day? There are 2 forms of revenue. What are they? Let me break it into 2. One is construction contract. Second one is sale of bricks. Is that not? Do you agree with me?
Yes.
Okay. Now, for construction contract, we need to determine it with reference to the methodology. Now, since we have agreed that we are using the output method, what we need to rely on is the independent valuer certification. And we are told that the value of performance obligations satisfied was 230. Okay. Now, let me borrow the expression I use it as a note so that I'll copy it and use it for this scenario. Therefore, revenue is a function of the value of work done and certified by independent valuer as contained in the contract. It is satisfied for how much? 230. Thousand. Do we all agree? Okay. Now, that is that. Second, which means I'll come here and say 230. Let me link it. Second, we sold bricks and the transaction price, which was separately agreed, was 14. Which means invariably, the revenue as a company, given that that's the only customer we have, is 244. Now we'll now deduct the actual cost, which I can call cost of what? Sales. What is our actual cost? Our actual cost also is a function. I think I can break it down. Let me also break it down the same way I've done for Okay. My actual cost, I can also break it down into one. That's my cost of sales. I can break it down into my actual costs incurred to date on the construction, and two, my cost of bricks sold. All figures in US dollars. Now, what is my actual cost incurred to date? 210. What is my cost of bricks? 10,000. Therefore, it means my total cost of sales is this. And therefore, my profits will be my revenue minus my costs. Okay. I can put this in red. That is that. Do we agree with this? Do we agree? Yeah.
Yes.
Okay, the next thing is to determine contract assets. My contract asset is my actual cost. Okay. Let me take this out so that I don't mix construction contract with any other thing involved. Okay. Now, what is my actual cost to date? My actual cost to date is 210, 450. My profit earned to date, since this is the first time I'm earning profits, if this is the second time, I will aggregate the actual cost to date from first to second year, my profit to date from first to second year. Those are the aggregate because balance sheet item is aggregate, not for the period. Now, invariably, this is presumed what my value is. How much have I invoiced? The amount I invoice, how much? Where's it?
210.
Amount invoice for work certified, 210. Which invariably shows that when you look at it, I've invoiced how much? I've invoiced 210 out of this. Okay, sorry, my profit to date, take note here, don't let us make a mistake. My profit to date here is restricted to the construction. Over time. Take notes so that we don't mix it up, because we nearly mix it up here. Now, take notes. The profit to date with respect to construction is not the same thing as the profit that we have recognized here as gross profit here. Why? Because this gross profit also includes other items that is recognized at a point in time, which means my profit to date or profit end to date on construction is simply the difference. Let me put it here. Is the difference between the contract revenue of how much in dollars? 230, and cost to date of cost to date was 210,450. Which then means that I'll come here I'll try and marry it together, which means this is simply the difference between 210 and 230 and 210,450. That is that. Now, invariably, this is the value to us less the amount invoiced, which means our contract asset is 20,000, and that report in our balance sheet. Next is to determine receivable or contract liability, and that is our amount invoiced. How much was invoiced? 210. Now, 210 was invoiced, less amount received from customer. How much was received from customer? We received 194. Now, technically, 16,000.
It's receivable.
Are you getting it now?
Yes.
Okay, 16,000 should have been our receivable. Is that not?
Yes.
Okay. Now, you see the 16,000 here. But take note, 16,000 is our receivable from construction contract alone. But we have supplied bricks for how much? 14,000 naira. That is also immediately receivable because the promised goods have been delivered, even when we have not invoiced. That is not part of what we do over time. This is peculiar in situation because it is revenue that is recognized at a point in time, which means in addition, we will recognize receivable attributable to supply of bricks to the customer. Receivable attributable to supply of bricks to the customer. Now, $14,000 is additional amount that the customer is owing us, and which make it 30,000, which means invariably the customer is owing me 30,000. Why I still have 20,000 that will become receivable when I've completed the other phase and the work has been duly certified. Does that make sense to us now? Does that make sense to us?
Yes, it does. Yes.
Okay. Any question?
Okay, please, I have a question. On
Yeah.
every contract, there's always the retention fee.
Yes.
You can only receive maybe 6 months or 1 year after the contract had been completed, subject to the performance of the outputs. Now, when something like that is not certain whether you will eventually get it or not, let's say if things go unfavorable, or maybe the project did not really perform as expected and you cannot access that retention fee. So as at the time the entity, I mean the contractor, is reporting, should he still go ahead and recognize that retention fee in the balance sheet? If he must recognize it in the balance sheet, should it be a contract asset or receivable?
Okay, I think you need to understand that retention fee is your portion of receivable that is withheld by the customer upon satisfaction of what has been done after the grace period or allowance period or period of assessment has been completed and nothing defective or otherwise has been observed. Now, your retention does not have any effect with respect to recognizing your revenue in most cases, because it's after the fact. After the fact in the sense that though you have completed the job, certain percentage of the amount that you have invoiced will not be paid to you. Not that we are not able to pay, but we are withholding it, which is integral part of the contract agreement, where it will be payable probably 6 months after the job has been completed. Now, the question then is, it is only after you have completely recognized all your revenue, it's only after that you may now evidence condition that suggests that you may not be able to collect all of these amounts based on the fact that there are defects in which the customer will have to incur costs to rectify. And part of your retention fee is like a penalty that will be used by the customer to rectify it. Or the customer might withhold it that, okay, come and rectify it. And as at the point you rectify it, you incur additional costs for you to be able to collect it. Which then means that until that time, additional costs you incur will be expense has been incurred. You can say it now. Now, your inability to collect it in part or in full is also going to be a function that triggers that such receivable by way of retention may have suffered an impairment loss. And in that case, such amount of retention may be subjected to impairment assessment in line with the requirement of IFRS 9. And usually, based on practical experience, you may much more use the provision matrix or normal experience that you might have considered from the perspective of your past practices. And that is that. Do you get what I'm saying now? Which means the issue of retention has no bearing with contract assets. It only has a bearing with receivable because the work has already been certified, done, completed, but allowance or grace is given that let us watch what happens in the next 3 to 6 months or more, so that if there's any defect, I can easily call upon you. And since your money is with me, you will answer. And if you don't answer, I proceed to calling somebody else to fix it and I pay the person. But if I paid you in full, by the time I call you, you give me different excuses and refuse to pick up the call. Do you get what I'm saying now? Does that make sense? Does that make sense?
Yes.
Okay. Now, there are other critical things we are going to discuss in part 3.
Still on retention fee. Sorry.
Yeah.
I noticed that different entities has policy around retention fee. And I believe that some entity may say their own retention fee is 10% of the total contract. Other may say is 25%. But is there a provision? Is there any provision made by standard in respect of a retention fee? That's one. Number
Okay.
two,
Yeah.
at what point will an entity seize receivable as suffered an impairment loss?
Okay, thank you. Now, let me start from the first one. Okay, your first question, you are trying to see whether there's a guidance from the standard. But take note, the standard is not to interfere with a contractual agreement between two parties. Therefore, the standard cannot take the role of management in terms of negotiating a contract, or the role of a customer negotiating a contract. No. If your contract says retention is 25%, so be it. If you say it's 5%, so be it. You can say now, it's not the role of the standard to determine contractual terms.
Okay.
Contractual terms are based on legal consideration, based on regulation that exists within that jurisdiction, and based on business decision of parties involved. And in that light, standard has no bearing. Standard is restricted to accounting for whatever transaction that has taken place or conceived between two or more parties. Does that make sense, sir?
Yes.
Second, the question you asked border on how do we subject a receivable to impairment? And I think we've done that in part 4, 5, and probably 6 of our discussion on financial instruments. Okay, and we said, based on practical experience, and especially for receivables without a financing component, the standard encourages the use of provision matrix as one of the major methodology known to practical experience. And you could go back to those videos on YouTube or on the Zoom link I gave to you guys of our past lectures, and you can also see it. And also the model, we developed model on it. You can also go back to that and check. Okay, but with those that have financing components are subject to the accounting policy of the entity to make use of general approach. We now have to categorize the receivables based on their nature, homogeneous factor, and some other things into those that qualify in those that belongs to stage 1 or stage 2 or stage 3. And based on the approach, general approach, the requirements with respect to each stage will have to be taken into consideration. And remember, all factors that you take into consideration includes both micro and macro economic variables in order to ascertain the following: your probability of default, your exposure at default, and your loss given default on the basis that you know, based on past experience and current information, your level of recovery, or what you call the recovery rate. And all of this will also be subjected to the effect of time value of money. And such will be by way of discounting those expected values on the premise of using your original effective interest rate. And I think that more or less summarizes it further, the question you ask. But you can go back to the video and the resource materials and our worksheet for the model we developed to further reference it for further understanding or better understanding, as the case may be.
Yeah.
Any other question? Okay, furthermore, in part 3, we'll look at common types of transactions or specialized transactions that has effects and in which the standard has provided enough guidance in determining the effect of them with respect to revenue recognition. At that point, we'll be looking at warranties. At that point, we'll be looking at revenue recognized from the perspective of principal and an agent. From that point, we'll look at revenue recognition with reference to the purchase agreement, or what we call repo transactions. We'll also look at issues that borders on consignment arrangements. We'll look at revenue recognition principle with respect to bill and owed arrangements. We'll look at revenue recognition with respect to sale with return, and we're going to look at that. We also look at revenue from customers' unexercised rights, or what we call breakage in IFRS 15. We further, although we have looked extensively on contract modifications, and I might bring one or two practice questions to further buttress our understanding on contract modification as we have discussed in part 1. But I want you to refer back to part 1 so that by the time we get to part 3 and look at further practical consideration, we'll be able to move along. We also look at customers' loyalty programs and other options for additional goods or services. And we'll end it up with disclosure requirements. And I think if time permits, we also look at further illustration on allocation of transaction price with respect to variable considerations. And at the end, we'll have made justice to one of the most important standards, which speaks to the top line of any company, which is revenue. Okay, any other question before we call it a day? Any other question before we call it a day? Okay, if you look at what we've done so far, we've been able to do justice to the 5-step model. And you could be able to demonstrate this understanding in any industry, organization you find yourself. And with no other question in sight, I'll say thank you very much for your patience and good night.
Thank you very much, sir.